Good morning, everyone. I'm Graeme Hills, Head of Tax at Duncan & Soplis. It is my great pleasure to welcome you to our Autumn Budget webinar. Thank you to each and every one of you for being here with us today. So Wednesday brought us the new UK government's first budget and its announcements ranging from tax, wages and government spending. It's difficult to recall a budget so laden with grim anticipation, with stark portents from the Chancellor and rumours covering tax rises for employers, increases to capital gains tax and changes to relief from inheritance tax. I think it's fair to say that in those regards, the autumn statement on Wednesday did not fail to deliver on those warnings. To explain more on that, I'm joined today by three of my tax colleagues, each commenting on their respective areas of expertise. Matthew Appleyard, our Head of Corporate Tax, Christine Newitt, Head of VAT, and first up, Emily Pattinson, our Head of Private Client. During this webinar, we'll provide you with a detailed review of the analysis of the budget's content, so far as we have it to date, and what it will mean for both businesses and individuals, including our perspective on how to navigate those changes. Finally, we'll end with a question and answer session where you'll have the opportunity to direct your questions to our panel. There should be a button at the top of your Teams session with Q&A on it, so please do click on that and put your questions in there for us. It's up to you whether you put your name on or not, but please do get involved if you've got a question for us. Joining us to answer your questions will be Lucy Guinness, Financial Planner at Castlegate Financial Management, Amy Codd, Private Client Solicitor and our Head of Duncan & Soplis Legal Services, and Danielle Chatwind, our Corporate Legal Director at Duncan & Soplis Legal Services. We're due to close around 10:15, so without further ado, let's get underway. Over to you, Emily.
Good morning, everybody. So I'm here today to talk to you about the announcements made in Wednesday's budget that affect private clients, so mainly individuals, trusts and estates. As Graeme alluded to, there were certainly some significant announcements that will impact heavily on private clients, with changes announced to the capital gains tax, inheritance tax and domicile systems. And we'll take a look at these in more detail as we go. So we'll kick off with personal allowances, although there's not really much to say. The personal allowance, so the amount that an individual can earn tax-free, remains the same and is fixed until April 2028, at which point it will rise with inflation. There are also the smaller allowances shown on the slide there and some small increases to note there. Labour have honoured their pledge not to increase income tax for working people. Therefore, the income tax brackets remain the same as they have done for the last few years. Dividend income, again, no change there. The rates are as they were last year. Dividends allowance was halved and then halved again in the last couple of years, and it remains at £500. So individuals can receive £500 of dividend in each year. They'll be taxed at 0%. In 2013, the government introduced the high income child benefit charge. The aim of this was to claw back child benefits payments that had been made to individuals who were considered to be higher earners. If one or both parents were earning more than £50,000 at the time, they were required to pay back some or all of the child benefit payments they'd received in a year. Once income reached £60,000, the child benefit they'd received had to be repaid in full. Since it was introduced, there have been a lot of complaints about this system being unfair, as the earnings threshold applies per parent and not per household. Therefore, a single parent family or a family where only one parent works could bring in a salary of £60,000 and not be eligible for any child benefit at all. Alternatively, there could be two parents in a household earning £49,000 each, therefore a combined income of £98,000, with full entitlement to child benefit. Now, the previous government did acknowledge this in the spring, and they did increase the earnings threshold to £60,000 in April 2024, with the benefit not being fully repayable unless the income tipped over £80,000. They also announced that they will be looking to bring in a new system that based the charge on combined household income rather than individual income. Now, we have had confirmation from the new government that they will not be going ahead with the plans to move to a combined household income system, but the earnings threshold does remain at £60,000. Moving on to national insurance, there's no change to the rates and thresholds for employees, again as promised. However, there is quite a change for employers. Employers are currently paying national insurance on salaries at a rate of 13.8%, on salaries above £9,100 a year. From April 2025, this will increase to 15% on salaries above £5,000, with this £5,000 threshold fixed until April 2028. This is a double hit for employers, unfortunately, with an increase in the rate as well as a reduction in the threshold at which they start paying. To try and offset some of this additional cost, there have been some changes announced to the employment allowance. So currently, employers with a national insurance bill of £100,000 or less a year are able to deduct up to £5,000 from their annual employer's national insurance bill. From April 2025, the £100,000 threshold will be removed so that the allowance is available to most employers, and the maximum reduction to an employer's national insurance bill has been increased from £5,000 to £10,500. Class 2 national insurance for the self-employed was removed in April 2024. However, it does still exist for any self-employed individuals wishing to make voluntary contributions. National insurance contributions are required in order that you are entitled to certain state benefits, most notably the state pension on retirement. Therefore, voluntary contributions might be made in order to fill any gaps in individuals' national insurance record. The Class 4 national insurance remains the same as last year at 6% on profits between £12,570 and £50,270 and 2% on any profits above that. Some changes confirmed to the minimum wages, which does bring good news for employees, but again, more cost for employers. The national living wage will increase, that's the wage for those over 21, will increase to £12.21 per hour from April 2025. The minimum wage for 18 to 20-year-olds will increase to £10 an hour, and the apprentice rate for 16 to 17-year-olds will increase to £7.55 an hour. So, of course, with the increased rates of employers' national insurance and the reduction in the threshold, this is yet another cost for employers. Making Tax Digital, or MTD, was announced by the previous government some years ago, and things had gone a bit quiet on the MTD front lately. This was the previous government's plan to move away from the annual tax return process and move to a quarterly reporting system. It's already been pushed back a few times, and while there was no specific reference to it in the Chancellor's speech, it does get a mention in the documentation that was released after the budget. The new government have confirmed that they are still committed to delivering the MTD project as planned, and it remains the goal to introduce MTD from April 2026 for individuals with qualifying income over £50,000, extending to those with income above £30,000 from April 2027. The government have also now confirmed that their aim is to have rolled out MTD to all individuals with qualifying income above £20,000 by the end of this Parliament. As we understand it, it is still the plan that income will be reported on a quarterly but cumulative basis, which means no need for an end of period statement because you can adjust each quarter as you go. And foster carers and those without national insurance numbers are still due to be exempt. We'll quickly touch on ISAs. There wasn't much to report there. It has been confirmed that the subscription limits for ISAs, junior ISAs and child trust funds remain the same as the previous year. Capital gains tax is one of the much talked about topics ahead of this budget, with lots of speculation that rates might be increased to align with income tax rates. So there have been no changes to the annual exemption amounts. That's the amount of gains you can have tax-free a year. They remain at £3,000 and £1,500, £3,000 for individuals and £1,500 for trusts. Now, while the rates have increased, they haven't increased as much as the rumours might have led us to believe. Some of you may remember that the CGT rates did used to be 18 and 20% several years ago, depending on whether you were a basic or higher rate taxpayer. In 2016, the lower rates of 10 and 20% were introduced for all assets other than residential property, with 18 and 28% remaining in place for residential property disposals. These remained in force for several years, and then in April 2024, the residential property rates were changed to 18 and 24%, and it's these rates that now remain in force for all assets. We've lost the 10 and 20% rates. Therefore, while it is business as usual for individuals selling residential property, Individuals disposing of any other assets will now suffer the slightly higher rates of 18 and 24%. It is important to note here that these rates did come into force on the 30th of October and therefore do apply immediately. For individuals disposing of qualifying business assets or businesses, business asset disposal relief, or BADR as it's known, has been available for a number of years. This relief enables individuals to pay capital gains tax on these assets at a flat rate of 10% on gains of up to £1 million over their lifetime. The good news is there's no immediate change to this relief as of 30th of October, but changes are coming. With the new lower rate of CGT being increased from 10% to 18%, the government do plan to align the rate of tax attached to BADR with this new lower rate. This will be done gradually though, with the BADR rate of CGT increased to 14% from April 2025 and then to 18% in April 2026. Now, despite the increase in rates, it has been confirmed that the lifetime limit will remain at £1 million. Moving on to pensions, no changes to note in terms of the contribution limits for pensions. The lifetime allowance was abolished from April 2024, and that remains the case. Individuals can still draw up to 25% of their pension tax-free, up to a maximum of £268,275. That hasn't changed. The annual allowance, which is the maximum you can contribute to your pension and still receive tax relief, remains at £60,000 for 25-26. As before, individuals with adjusted incomes over the £260,000 mark may be tapered down to the minimum allowance of £10,000, but £10,000 is as low as it will go. Right then, on to inheritance tax, and there were some significant changes announced here, but we'll start with the basics of IHT. The nil rate band of £325,000 has been in force since April 2009, meaning that the first £325,000 of assets in an individual's estate when they die are free from IHT. The residence nil rate band was introduced in 2017, which is an exemption of up to £175,000 against the value of an individual's main residence in their estate, but only when they leave it to their direct descendants on death. For individuals with estates worth more than £2 million, this band begins to taper away, and those with estates worth more than £2.35 million are not entitled to this residence nil rate band at all. Both of these nil rate bands are transferable to a surviving spouse or civil partner if they're not used on death. Therefore, if the first spouse to die leaves everything to their surviving spouse, as spouse transfers are exempt from IHT, none of the bands are used, and the surviving spouse can have an estate of up to £1 million on death without being subject to any IHT. The previous government have frozen these bans until April 2028, and the new government have announced they're extending this freeze until April 2030. In documents released after the budget, there was an announcement of a plan to digitalise the inheritance tax service from April 2028. This will hopefully be a much more efficient service than the one in place at the minute, as the one in place at the minute, as some of you will be aware, relies on the manual completion and posting of paper forms. So it'll be certainly interesting to see what that looks like. One of the big announcements in Wednesday's budget was a significant change to how pensions are to be treated for IHT purposes. So pension pots have historically been excluded from the value of an individual's estate for IHT purposes because they tend to be written into trust and therefore sit outside of your estate. Therefore, at the minute, you're able to build up a significant pension pot during your lifetime and pass it down to the next generation free of IHT. Now, when the Chancellor made her speech on Wednesday, she said that from April 2027, it would be inherited pension pots that would become subject to IHT. However, documents that have been published since make no mention of inherited pensions and instead suggest that IHT will become payable on all unused pension funds or death benefits. The IHT on these funds, along with the IHT on the rest of the estate, would be calculated using the new proposed online IHT system, with any inheritance tax due on the pension fund being payable by the pension administrator directly from the pension fund. This is, of course, a blow for individuals who have been building up their pension pots with the plan to pass them down to the next generation. However, we are still waiting on more detail on these changes. There's a consultation plan to take place over the next few months, and once we have the results of that, we should have some clarity as to what exactly they mean by unused pension funds. Another big announcement on Wednesday was an overhaul to the way that agricultural property relief and business property relief work, APR and BPR. Currently, provided that assets meet the qualifying criteria, agricultural property and business property can attract 100% IHT relief no matter what the value. Now, from April 2025, APR, which is currently mostly available on agricultural land, will be extended to include land managed under certain environmental agreements. However, from April 2026, the rules surrounding APR and BPR will change significantly. So historically, farmland businesses could potentially be passed down on death or settled into trust with little to no IHT consequences. From April 2026, 100% relief will still be available, but it will be capped at a limit of £1 million. The £1 million limit will apply to APR and BPR combined. It's not a limit per relief. If an estate contains assets that attract both kinds of relief, the £1 million limit will be prorated between the two. APR and BPR will still be available on the value of any qualifying assets exceeding the £1 million mark, but at a reduced rate of 50%. So with the rate of IHT being 40%, this means the effective rate of tax on agricultural and business property will be 20% when it was previously zero. There is also a specific change to the BPR available on shares designated as not being listed on a recognised stock exchange. The most common example of this we see is AIM shares. These shares previously qualified for 100% BPR. However, the relief on these shares will be reduced to 50% from April 2025. Therefore, along with any other assets that only ever qualified for 50%, these will not sit into the £1 million limit. These changes are, of course, a blow to farmers and to business owners who are planning to pass their wealth down to the next generation free of IHT. But it is important to bear in mind at the minute that we don't have all the detail yet. It has been confirmed that unlike the nil rate band and residence nil rate band, the £1 million limit will not be transferable to a surviving spouse on death. It has also been confirmed that anti-forestalling provisions are already in place in relation to lifetime gifts. So an individual can make a gift during their lifetime, and if it's IHT free at the time of making the gift, provided that they survive for 7 years, it will remain IHT free. Any gifts made before the 30th of October will be unaffected by these changes, but any gifts made between the 30th of October 2024 and April 2026, where the individual passes away after April 2026, but before their 7-year window closes, the £1 million limit will apply retrospectively to any gift of agricultural or business property. There is a consultation on this taking place, and it's due to be published in early 2025, which should provide more detail on how this limit is going to work for lifetime transfers, both for individuals and for trusts. So we'll touch on trust a minute. As you may be aware, there are certain types of trust that are subject to an IHT charge of up to 6% on the value of their assets every 10 years. The same £1 million limit will apply to trusts, with value over this again only benefiting from 50% APR or BPR. It has been confirmed that any trusts that were in existence before the 30th of October 2024 will have their own £1 million limit. However, it is anticipated that any trust created from now on, if an individual creates more than one trust, the £1 million limit will be split between them. However, we should get confirmation of this when the results of the consultation are published. Moving on to domicile. So it was mentioned in the spring budget that the domicile system was being looked at. So typically, if an individual is resident in the UK for tax purposes, they're liable to UK tax on their worldwide income and gains. However, if they are not domiciled in the UK, they're not required to pay UK tax on any overseas income or gains unless they physically bring the money into the UK. If they don't bring it into the UK, the payment of UK tax is optional. From April 2025, the domicile system will be abolished. It will be replaced with a simpler scheme based on residence. The new regime will provide 100% relief on foreign income and gains for any new arrivals to the UK for their first 4 years of residence, provided that they've not been tax resident in any of the previous 10 years. For individuals with any foreign assets that will be captured by this change, they will be able to rebase any assets that were held as at 5th of April 2017 to their value at that date, which will give them an uplift in base cost for CGT purposes. These domicile system changes will also apply to inheritance tax, as your liability to inheritance tax relies purely on domicile at the minute. At the minute, non-domiciled individuals only pay UK IHT on their UK assets, regardless of their resident status. So a new residence-based system will change this, with non-UK property being brought into the scope of UK IHT for both individuals and trusts that are considered to be long-term residents. That's all from me on all things private client, and I'll hand over to Matt, who will talk to you about the corporate side of things. Thank you.
I hope this is working. I think I've just seen myself now. So good morning, everyone. Thank you, Emily, for all of that. And what a budget, certainly a budget for change, impacting on many businesses and households as more and more value gets brought into the tax net. I'm sure more will come out of the various consultation documents that Emily mentioned before. That being said, I'm going to be pretty quick. There were very few changes in relation to corporate tax. So I'm going to cover two small changes in relation to stamp duty land tax, as well as some changes with regards to employee ownership trusts, just to fill my time. Those of you who have attended our budget seminars before will be pleased to know that this year I have had to sign and agree to several contractual changes over the last few days to ensure no more silly jokes, as it was termed. Slightly hurtful, but anyway, we'll get straight into the budget. So what are we going to cover? Well, I'm going to confirm that there are no changes to the rates of corporation tax. I'm going to confirm that there are no changes to the reliefs afforded under the Capital Allowances Act. I'm going to confirm that there are no changes to innovation reliefs, including research and development and patent box, other than those changes that were already announced with regards to the merged research and development scheme. There will be some consultations being brought out in spring of 2025 regarding land remediation relief. So I'll cover what could happen in those. As I mentioned, I'll cover the two small changes to stamp duty land tax, as well as some clarifications and slight amendments to employee ownership trusts. As I said, nothing's really changed with regards to the rates of corporation tax, and now we're told it won't for the duration of Parliament, which is positive in terms of planning. Many of you would have gone through your first year end where the rates of corporation tax have changed. In fact, they reverted back to almost a Labour government where we had associated companies and small profit rates and larger profit rates as well. Just to recap, in terms of those rates, so you've got 19% rate up to 50,000. Between 50,000 and 250,000, you're into a marginal tax rate, which actually works out to be 26.5% on profits earned between those levels. And then profits over 250,000, you're just at a flat rate of 25%. These limits are reduced for shorter accounting periods and in respect of associated companies. So just a quick recap on that. As a company is associated with another one at a particular time, if during that time or the preceding 12 months, one company has control of another, or both companies are under the control of the same person or group of persons. Talk about what's known as minimum controlling interest there. We will, for those of you who are Duncan Topless clients, we will naturally work this out for you, but more than happy to assist if anyone's got any queries. And that just recaps those tax rates. So as I said, profits at 50,000, 19%, between 100 and 250,000, you're into a marginal rate of 26.5% on those profits over and above. And then over that, you're at a flat rate of 25%. Capital allowances, again, for the duration of Parliament, apparently nothing's going to change. Full expensing is here to stay. So what's that? Well, you can write off 100% of assets that are new and qualifying for main pool expenditure, or you can allocate a 50% write-off for those that are, again, new and special rate pool expenditure. It's effectively a first-year allowance. These are available to companies only in respect of full expensing. The annual investment allowance, again, we've told throughout the duration of Parliament, that's going to be capped at 1 million. The 100% first year allowance in respect of zero emission cars and charging points, that's going to be extended until 31st of March or 5th of April 26 for unincorporated businesses. And they are still discussing proposals to extend full expensing for plant and machinery that is acquired in order to then hire or lease out as part of your business. Innovation reliefs, not going to change. They're going to keep the R&D reliefs at the current rates and look to improve on the administration side of things. R&D has been an absolute thorn in my side for a few years now, since the team in HM Revenue and Customs that have absolutely no experience in research and development got parachuted in order to start inquiring into very technical areas of research and development. They have a script, and their script effectively means that right at the end of it, they deny R&D relief in full. It's a shame that we've got to go through it all. But ultimately what happens is you'll get to the end, the R&D relief will be denied, and then we will send it across to HM Revenue and Customs Solicitor's Office, who have a team of experts that will then be able to review that R&D claim. Unfortunately, the Solicitor's Office, while they usually have to take a maximum of 45 days to turn around a review, are now into years in terms of turning around these reviews, just because they've been absolutely inundated. I think it's most definitely been a case of shooting yourself in the foot with HM Revenue and Customs. Thankfully, however, there is a consultation on being able to go for advanced clearance in respect of your research and development claims. In fairness, that will probably be most welcome by a lot of advisors. It will provide certainty. It will mean that you'll be talking to technical officers in order to be able to clarify certain areas in relation to research and development, and taxpayers will know going into their R&D claim that they will be able to be successful in that claim, assuming they stick to what they've said in the clearance. There are two small changes in respect of R&D. One impacts companies in Northern Ireland and just clarifies the ability to make a claim while also receiving a grant of sorts. And the other is a technical change to an incorrect interpretation by HM Revenue and Customs in relation to R&D intensive companies. So what's effectively happened there is you can make a claim for R&D intensity, and as a result, your refund that you can receive for surrender of losses would increase. In terms of R&D intensity and the costs that are included in that claim, HM Revenue and Customs have only been including those claims that qualify under the small and medium enterprise, the SME scheme. That's technically never been true. It should have also included costs associated with the larger research and development expenditure credit scheme. There's been a lot of backwards and forwards with HM Revenue and Customs, who Computer says no, initially deny the claim, but on appeal have been accepting it. It's been a lot of administration changes, and this is the technical change to ensure that HMRC systems are updated to what Parliament always intended. Sandbox, the regime will be maintained throughout current Parliament, which is positive for clients, claiming the patent box regime, which allows a reduction and a flat rate claim to profits qualifying under patent box at a 10% corporation tax rate. So very much worth it if you have if you are exploiting relevant IP. So what does the merged R&D relief scheme look like? Well, it looks like what it shows on your screen now. Right now, on the left-hand side, we're getting an 86% enhanced deduction for qualifying costs, which give a net additional CT relief. This assumes a company that pays corporation tax at 25% of £17,200. Under the merged scheme, which is what's on the right of the screen, what happens is you get research and development expenditure credit. It's flat rate of 20% on qualifying costs. It increases your taxable profits by 16,000, but it then provides for a pound for pound reduction to your corporation tax bill. And so it's a net 75% benefit, and hence, unfortunately, the hit in terms of the reduction in CT reliefs going forwards. So land remediation relief, the government will launch a consultation in spring 2025 to review the effectiveness of land remediation relief as it currently stands. In particular, they note they're going to do this to consider whether relief is still meeting its objectives and is good value for money. It's not really changed, as it says, in the last 23 years. What it does is it provides for an additional 50% relief on qualifying costs. So that includes things like removing asbestos from buildings, or Japanese knotweed, or or making other contaminated land that you have acquired good. Where you've made losses in relation to a land remediation relief claim, you can actually surrender those losses for a 16% repayable tax credit. The concern is that we're 23 years on into this regime now. It's potentially likely that the government could look to reduce the effectiveness in terms of the reliefs, or potentially remove them in its entirety. Watch this space, and hopefully I'll have more news in spring 2025 or autumn 2025 once the consultation is hopefully starting to progress a little bit further. Where you do have land remediation relief claims, let's make sure they're done and dusted and all submitted well before any potential changes. Nearly there. Stamp duty land tax changes. So just two small changes with effect from the 31st of October 2024. They've increased the surcharge by 2% for the acquisition of second homes, or the acquisition of residential properties by companies or what they call non-natural persons, which is usually a trust. So you'll now pay 5%, not the end of the world, but it again becomes another cash flow issue. As well as increasing the surcharge, they've also increased the flat single rate, which is applicable when a company, or again a trust, they deem a non-natural person, acquires a residential property which is worth £500,000 or more. Initially, the company or trust would pay a flat rate of 17% stamp duty land tax on that property, which can become incredibly prohibitive. But there are lots of reliefs available because really this particular stamp duty land tax cost is trying to disincentivize the acquisition of your residential home in a company, because that's where your cash is. That's what it's all about. It aligns with the annual tax on envelope dwellings, and that's really what it's trying to stop. Last one, I told you I'd be quick. I'm there now. Employee ownership trusts. I feel as though these are probably going to become more common, especially with the increase in capital gains tax rates going forwards. So what is it? It's a type of trust which is set up to allow employees to purchase a controlling stake in that company. Where a controlling interest in a trading company is sold to an employee ownership trust and various other qualifying conditions are met, the shares or the gain rather is exempt from capital gains tax. It's deemed to be sold at no gain, no loss. So there's no CGT to pay. In addition, an employee ownership trust can start paying bonuses free of income tax up to £3,600 per year per employee. There have been some changes as needed in the legislation because employee ownership trusts were being abused and not used for what they were intended to. So there are further restrictions on former owners or people connected to them from retaining control of the EOT. So what does that mean? Effectively, what that's trying to stop is a sale of the company to an employee ownership trust, and then the former owners being the controlling trustees of that trust, and therefore still controlling the company. My understanding is that they now must have less than 50% control of that trust, and the other 50% must pass to, for example, employees or professional trustees. The trustees must be UK resident at the time of the disposal. What that's trying to stop is a sale to a non-UK resident trust, and therefore escaping the UK tax net on an eventual sale again of that company to a third party by the employee ownership trust. The trustees must ensure that the consideration paid does not exceed market value. In fairness, with Duncan and Topless, we've always ensured that, and our head of valuations, Ellie Scotland, who is also an expert in employee ownership trusts, would normally insist that a valuation report is done, and this is the reason why. She's seen on the horizon for a number of years now that the government will crack down on individuals selling their companies at overvalue to an EOT and cashing out too much. Vendor clawback period. So what that's effectively meaning is that you've got to continue to meet the conditions required as an employee ownership trust. Previously, that was 12 months from the date of exit. Now it's 4 years. There's going to be much more onus on the selling shareholders to ensure that the internal management team and the various boards that are required to be set up will continue to work in the right way for the following 4 years, so that there is no clawback of their CGT reliefs. There's some additional reporting requirements, and that's just to ensure that HM Revenue and Customs can continue to track the effectiveness of employee ownership trusts. For example, I think you've now got to ensure that you return just how many employees will benefit from this employee ownership trust. So if you've got a company that sells to an EOT but you've only got 2 employees, HM Revenue Customs are going to see that as pretty aggressive planning. A thankful clarification in terms of distributions to an employee ownership trust. We've been saying for a number of years, in fact since they came in, that the distributions to an EOT are tax-free. This is what we've known. There's been a number of clearance applications available in order to confirm that point, in order to reduce the administrative burden and ensure that everybody knows that what Parliament intended from the start. This confirmation has now been brought into the legislation. So money is going to an EOT in order to repay vendor loan notes, etc., tax-free. And finally, a small amendment to the requirement for annual bonus payments. It used to be an all-employee thing, so every employee had to benefit from this £3,600 per year bonus if it was going to get paid. But the EOT now has the ability to exclude directors. Bit harsh, but fair enough. It's something they can do now. And that brings me to the end of my slides. I told you I wouldn't take long, and I now pass over to Christine Newitt to talk about VAT duties and all things in her expertise. Christine?
Good morning, everyone. Hopefully you can see my screen right now. Thank you very much, Matthew. A few changes there. I'm going to spend the next sort of 10, 15 minutes talking about changes relating to indirect business taxes. So I head up the VAT team at Duncan & Topliss, but I'm going to start with sort of a few general changes that are occurring within HMRC. My slides are refusing to move on. I'm not quite sure what's happening. There we go. Helps if I'm clicked on the right screen, doesn't it? And so investment in information technology was one of the announcements that Rachel Reeves made, looking at modernising the system. So Emily has already touched on one of those, which is the online digital platform for IHT submissions and also making payments of IHT. HMRC are also looking to modernise their app to enable taxpayers to make voluntary advance payments. And this is sort of a general movement really with HMRC moving much more to self-serve and digital payment systems. Also on the debt management side, they're looking at new case management software to enable them to handle more debt management cases and consequently collect more debt. And then on the theme of debt management, anyone paying their tax late, there's an increase announced on budget day of the late payment interest rate, which has gone up by 1.5 percentage points. So it's now bank base rate plus 4%, and that will be effective from 1st of April 2025. So they quite clearly don't want you to use HMRC as a banking arrangement for your business to support your cash flow. Also investment in debt collection. So they're funding another 1,800 debt management staff. They're also funding investment in credit reference agency data, which will enable them to better target debt collection. And funding for 5,000 additional full-time equivalent staff. Excuse me. By the end of this decade to tackle the tax gap. So that's the perceived gap between what HMRC perceive they should be collecting and what they're actually collecting. So moving on to VAT, the standard rate of VAT remains at 20%. So that is honouring their pledge that they said the main rate of VAT wouldn't increase. The threshold went up in April of this year and that remains the same. So businesses with turnover below the threshold of £90,000 will not be required to register, but once you reach that threshold, you're required to register for VAT in relation to your taxable supplies. Excuse me, I've got a bit of a frog in my throat. VAT treatment of hire vehicles. So in spring of this year, there was a consultation released relating to the High Court ruling in Uber Britannia. And the outcome of that consultation was due to be published at the autumn budget, but there's been nothing published as yet, so that is awaited. So I won't dwell any further on that at the moment. So the big announcement, hugely controversial, already much publicised from the day that the day of the election, effectively. Labour were very quick to put draft legislation out. There was draft legislation in place by the 29th of July. So independent and private schools have had some time to look at all the detail. There was a consultation issued at the same time, and the consultation outcome was also published on Wednesday. As I say, it has been hugely controversial for those that are impacted by this. There are some legal challenges, mainly around human rights, discrimination, etc. Independent Schools Council representing parents, they also decided yesterday to launch a legal challenge. So there are several legal challenges relating to this, but in the meantime, private and independent schools do have to get to grips with this. They can't ignore it, despite the challenges that are happening. So current rules are that education is exempt in relation to VAT, so no VAT is charged on school fees. From terms beginning on or after the 1st of January 2025, then a standard rate of 20% VAT will be charged on those. Compulsory school age, so from to impact A-level education, so is providing education to that age range, so sixth form colleges. Apply to non-maintained special schools, so there are some independent, majority public funded in those independent schools, and the VAT charge isn't really going to impact much on the funder, because the funder as a local authority will be able to recover that VAT because they're under a special regime known as the Section 33, that regime. It clearly will impact those that are not publicly funded, so they're not going to be excluded from this, and this is one of the challenges that's taking place at the moment. Many private schools offer advance payment schemes, and you'll be aware that there was quite a large take-up for these schemes prior to even the election day, because we weren't at that point sure when these rules would come in, whether they would come in from September or maybe later on. So anybody that's paid fees before 29th of July, which was when the draft legislation came out, as long as that's created a tax payment, a tax point for VAT purposes, and I won't go into those rules on this webinar, but as long as it has created that tax point, then those fees will be exempt from VAT. Any prepayments for the January term onwards that were received by the schools from the 29th of July 2024 will need to be considered. So if you've already paid some fees excluding VAT, you may be receiving a fee for the VAT in the future. And we are assisting a number of private schools. It's clearly quite challenging for them to navigate this. It's not a regime that they've had to anticipate previously. So many of them are not VAT registered. Some private schools are VAT registered because they carry out other activity which is taxable, but many of them aren't. So I would encourage conversations with the school if there's any parents watching this webinar to just sort of understand how this will look going forward. It won't apply to nursery classes, so a lot of private schools offering education to pupils of compulsory school age also have preschools, and it won't apply to that, so that will continue to be exempt, which is another challenge for the private school sector because they're now having to deal with what's known in VAT as partial exemption rules and calculations. So we're assisting with that also. It won't apply to higher education courses. This was mainly an exclusion for the more specialist schools for performing arts, where they may have a age range of children from 16 onwards, offering both higher education and compulsory school education. Doesn't apply to further education colleges, they will remain exempt, as will independent training or learning providers or any schools that teach English as a foreign language course. In relation to what the 20% VAT charge relates to, this is also a bit of a challenge for private and independent schools. It applies to the tuition fee element and the boarding fee, if it's a boarding school. But some of the other, what you would consider more closely related supplies, like school meals, school transport, school trips, etc., they will remain exempt. But whether or not VAT has to be charged will depend on whether it's classed as a multiple or a single supply. And this is a conversation that schools are having sort of within the school and also with parents regarding how their fee structure will work going forward. So you may well have been used to one fee being applied to encompass everything. You may start to find that schools are splitting out some of those elements, or they may not be. The issue is for the school is if they're exempting a supply, then they can't recover the VAT on it. So in some respects, they've still got to pass that VAT cost on. Children with special educational needs, an education and healthcare plan in place will be within the scope of this policy, as I've already stated. So where they're not publicly funded, that will be an additional cost for a private funder. So moving on to business rates from the 1st of April 2025. Again, a hit for private schools will no longer be eligible for charitable rates relief. Those private schools that are wholly or mainly concerned with providing full-time education to pupils with an EHCP will remain though eligible for that charitable rates relief. The business rate standard multiplier increases from April 25 to 55.5 pence, but the small business multiplier rate has been frozen at 49.9 pence. And some support for retail, hospitality and leisure, 40% relief on their business rate liability, on the calculated liability, but there is a cash cap to that of £110,000 per business. And then finally, just to round up some other indirect taxes and levies, we were all relieved to hear that fuel duty wasn't going to increase, and our haulage businesses were probably also very pleased with that. The vehicle excise duty will increase in April 2025, other than for the lowest rate of VED, which applies to zero emission vehicles. And the new vaping products duty, which I went through on the spring budget, that will come in from the 1st of October 26. some announcements on tobacco duty and hand rolling tobacco duty. So tobacco duty, the escalator of 2% plus RPI will continue to apply, as it will also for hand rolling tobacco duty, but there's been a further increase on that, on the hand rolling tobacco, by a further 10%, effective from budget day. Alcohol duty, an announcement there regarding the increase in relief for draft beer, which is anticipated to reduce the duty by 1 pence on an average pint of beer. And plastic packaging tax, which I know a lot of our manufacturing businesses are involved with, that will increase with CPI, and that's a tax on, as the name suggests, plastic packaging, where 30% or less is recycled plastic. So that's going up to £223.69 per tonne. And that concludes the indirect taxes. So I think I'm now going to hand over to Graeme for the question and answer session. So thank you very much.
Thank you very much, Christine, and thank you to Matthew and Emily as well. Very much appreciate you spending so much time putting your thoughts into this at such short notice. We're going to move on to the question and answer section now. I always worry before these sessions I need to preload a few questions just in case we don't get anything through. It looks like my questions will have to wait. We've had an awful lot of questions come through, so we'll try and get through as many as we can. Quite a lot of these are related to the private client, personal tax and inheritance tax rules, but we'll try and spread these around so it's not just another presentation for Emily. But we'll start with Emily. So Emily, question from Richard. Is there any possibility that the APR rule changes mentioned with effect from April 26 may get reversed by government, given the serious concerns that these changes have caused within the farming sector?
There has been a lot of concern in the farming community. Obviously, a lot of worry that previously farmers were able to pass their farms down effectively IHT free, and now there's a real concern they're going to have to start selling off land that they've worked their lives to build to fund the IHT. There's also concern that the increased costs for farmers are going to have to be passed on to the people. I know that the president of the NFU has released a statement calling for an urgent review, if not complete reversal of this. So it's just a case of wait and see at the minute, and see whether any action is taken as a result of that.
Absolutely, thank you. One for you, Lucy. Pensions related. Does the IHT apply to inherited pensions from employment pension, such as the MOD pension, when this passes to a surviving spouse?
Yeah, the rules still apply if it's passed between spouses. There is an inheritance tax exemption, so there won't be any inheritance tax to pay between spouses on pensions, even after the rules change.
Fantastic, thank you. Matthew, a question about stamp duty for you. Does the SDLT 2% increase affect just the 3% starting rate to take it to 5%, or is it an extra 2% on all the rates depending on the property purchase price?
Yes, it's an extra 2% on every threshold rate depending on that purchase price. So up to 250,000, you'll pay 5%. On the next £675,000 worth of value, up to 925,000, you'll pay 10%. The next slab up to 1.5 million, you'll pay 15%, and the remaining value above 1.5 million, you'll now pay 17%, and that's all up 2% from where it was previously.
Fantastic, thank you.
It's not fantastic.
Well, no, but thanks for the clarification, at least. Emily, coming back to you. Sorry to ask you here which one to go for next. Will farmers be able to benefit from the standard nil rate bands? This is the IHT question, and then top up when the £1 million APR limit?
We believe so, yes. So as things stand, when you're calculating IHT on an estate, you look at all the assets, you knock off the reliefs, and then you deduct the nil rate band from what's left. So it's imagine this will still apply in the same way. There's just an adjustment to the calculation at the top. So you'll deduct as much APR or BPR as you now can, given the limits, and then you'll come down to taking your nil rate bands off. So yes, you'll still be able to benefit from the nil rate bands on top of this new limit.
Great, thank you. Amy, one for you with regards to the payments of IHT. What's the period of time for payments of IHT where land is involved? Is there a specific provision for liabilities of land? As I've seen 10 years quoted, and with the interest payable, and what rate would that be payable at?
So I think the key for this really is that nothing has significantly changed in terms of when the first instalment is due. The first instalment will be due at 6 months after date of death. At that point, then any unpaid portion will be paid in instalments, and will still be on instalments over a 10-year period over this time. But significantly, we haven't had to deal with that before because obviously we've had the release to use. So the big thing will be that it is linked to the base rate. So you've got the base rate plus you've got the amount on top of that. So we've seen that significantly rise in the last couple of years. At the moment, it's 3% on top of the base rate. But we'll see what happens with that. It'll be something farmers haven't had to look at before and something we'll have to look at again with our planning.
That's great, thank you. Emily, a clarification on inherited pensions. Will they then also be subject to income tax?
Good question. So generally speaking, at the minute, the income tax you pay on a pension you've inherited depends on how old the person was when they died. So if they died before they were 75, typically there's no income tax payable by the person that inherits it. But if they were over 75, you can expect to pay some income tax. All that's been said at the minute in the documentation that's been released is that the income tax treatment will still depend on the age of the pension member when they died, but that is all we really know at the minute.
Thank you. Danielle, one sends your way. How should property investors be changing the way they pass down their portfolios to future generations following the budget changes?
So I don't think anything's really going to change in that regard. So transfers to trusts or the formation of family investment companies still remain viable options. But I think the key message is that tax advice is sought because every circumstance is bespoke. Yeah,
no, absolutely. Matthew, one that's been specifically directed towards you here. Are you expecting the APR rules to have an impact on agricultural land values?
Okay.
Well, your name on it has come your way, I'm afraid.
I know. Yeah, I get it. Number one, I'm not a land valuer, so I'm just going to caveat that from start to finish. Will it have an impact on the land values? Do you know, I think there's so much planning available in order to mitigate the inheritance tax on agricultural value being passed down that from a normal viewpoint, I would suggest no. My query would be these larger purchasers of land that have held them specifically for inheritance tax relief only, that are now being caught in the inheritance tax net, whether they will start to exit from the landowning market. And if they do, that could then end up causing a knock-on impact on agricultural values. I think his name begins with a D.
Thank you very much. Emily, a couple for you on gifts here. One from Steve and one from Esther. What about what qualifies a gift as being IHT free? Another view on gifts made between now and April 26 when the rules are changing, if there's any view on what might be happening in that transition period as well.
Yeah, so a gift is IHT free if you make the gift now and then you live 7 years. So it's called a potentially exempt transfer. The key being potentially, i.e. you survive the 7 years, it's exempt from IHT. So that's IHT free. A lifetime transfer can also be free from IHT at the minute if, say, you make a settlement into trust, which would normally be immediately chargeable to IHT, but there is currently the available of APR and BPR to make, so there is no tax payable on charge. The difference to this from now until April 2026 and then April 26 onwards is so for both the pets and the transfers into settlement, if you'd made those gifts and paid no IHT at the time and survived the full 7 years, then you'd never pay any IHT. even on the ones that, you claimed APR and BPR into trust, you died within the 7 years. As long as the asset still held its APR or BPR qualifying status, you still wouldn't have paid any APR or BPR. So from now till April 26 and then April 26 onwards, if I was to settle agricultural land into trust today, and it was more than the £1 million, and therefore I would pay no IHT today, but I died in 2027, so after the rules have changed, but before the 7 years are up, the say £2 million gift that I had made would be re-exposed to IHT, and the £1 million limit would be applied retrospectively. So the first £1 million of my gift would still benefit from 100% APR, but the other £1 million of my gift after that would now be subject to only 50% relief.
Yeah, right. Thank you. One for the panel at large then. Does the panel think that the changes to IHT on farmland are just the beginning of more to come? So it could be further reducing of the 1 million exemption and increasing the 20% in the future. Anyone want to weigh in on that one?
I think the biggest thing is the speculation. I think, as we all found in the run up to the budget this time, the speculation is probably the thing that is panicking people more than anything else. And I think the biggest thing people can start to do is actually deal with the facts and start to put some planning in place and have those conversations early on, because we just don't know what's around the corner. We don't know what their plans are. It was the biggest budget we've had for a long period of time, and planning is the key that makes sure that everyone looks at what they've got in place at the moment, what it does for the changes that we've currently had, and make sure we start that planning process early. That is the key. So we don't know what's in the next budget. We don't know what the next plans are. We can all speculate, but I think it's really important that we deal with the facts we've got now in preparation for what could be more changes. And there is much speculation again that this is only the start.
Yeah, I'd agree. I mean, I think Rachel Reeves has come out saying she doesn't want to do this again. It was meant to be a one-off budget, but I think there's also talks this morning about potential funding shortages even after all these changes. So it'll have to be a watch this space with some trepidation, I think, overall. So talking of speculation, this one for you, Lucy. What impact do you think the capital gains tax changes will have on investments?
I think ultimately it would depend on what investments you hold. Pensions and ISAs still remain capital gains tax free. From the 30th of October, obviously, as Emily spoke about, the rates of them taxes have changed. And this would be on things like direct shares, unwrapped investments. It is still worth noting that if you pass away with a capital gains tax liability, the current rules still allow that to pass tax-free. So the capital gains clock will go back to 0 and that clock will start again at that point. This may be something that you keep in mind if you're planning, or if you have large capital gains tax liabilities, and how you kind of manage them in the succession planning.
Thank you. A couple of questions about farming businesses in particular. One for you, Matthew. If a farm is a limited company, how is IHT treated? So if, say, the grandparents hold 50% of the current shares, and the next generation hold the other 50% shares, and they're the directors, what might the IHT liability be? Obviously, we can't give full answer to that on this one. That's obviously a bit more advice needed. But would the older generation need to give their share to the younger generation and then live for the 7 years to avoid IHT?
Yeah, so in terms of the value initially, when it comes to companies, 50% isn't worth 50%. You have what's known as minority discounts attaching to share values. And the reason for that is it's there to reflect a reduced power associated with that company. So lower voting rights, for example. At 50%, you can't actually get absolutely everything pushed through that company that you want to. With farming companies, it is suggested that a minority discount attaching to a 50% shareholding could be anywhere between 15 and 25%. But I would always defer to our firm's valuation team, headed up by our colleague Ellie Scotland, for that. So if you do have queries on your company valuations, I'd highly recommend getting in touch with her. In terms of planning, look, there's a lot of planning that you can do in relation to passing things down. You can do your lifetime giving, and you can gift potentially with the benefit of capital gains tax holdover relief. so that it leaves your estate. And as Emily highlighted earlier, if you survive the 7 years, then it is outside of your estate for the purposes of inheritance tax. Another alternative is that you can insure yourself against the inheritance tax liability through life insurance. And I'd absolutely recommend speaking to CFM, whether or not they've got a cat on their shoulder. I did spot it. To discuss that. You've nearly got one of two choices now in order to avoid inheritance tax. You either do lifetime giving, in which case you won't get your CGT uplift, or you insure your inheritance tax liability, in which case you do get your CGT uplift, and it will always be a cost-benefit analysis of each. What I don't think this budget is going to do is it's not going to break farms. You've just got to get in front of the planning, as Amy said earlier, and once you're in front of it, you can then rest assured that succession is secured.
I agree with you, Matt, there. Just to add that we work really closely with the tax team so we can implement things as a one firm approach to make life easier for everybody. But the key message is do something about it now. There are things that can be done.
Yeah, absolutely. And just on that point about the sort of life insurance, Lucy, do you have any thoughts on what impact this budget changes might have on that, and what those solutions might look like?
It's tricky to answer, really. I think I'm a bit distracted by the cat, to be honest. I think, you know, with any planning now, I think there will be changes at how we look at that. You know, particularly what investments you use, whether, you know, what kind of life insurances that we might use. I think as an industry, we need to kind of come to grips with those changes and what they mean for us, so we can sort of do the best for our clients in the most informed position. I think that's the main thing. Yeah,
that's great. Thank you. But we are running out of time, so we'll try and get through as many of these questions as we have been able to, but we are running short. So we'll have the last one or two questions. One for you, Amy. Are inter-spouse transfers still free of tax or IHT? There was a reference to non-transferable allowances, so Emily did, I believe. Any thoughts on how that's going to pan out?
I think Emily covered that in her presentation very well. So at the moment, as we know, inter-spouse transfers are absolutely fine. And I think it's making sure we take advantage of that in our planning. Again, there's things we can do to make sure people aren't using two allowances. So you're going to have spousal transfers, which are going to be exempt, but you're also going to have things now with the potential cap on APR and BPR. So rather than, the key thing I would take away from that is, rather than everyone leaving everything to each other in wills, which is traditionally what we do, we need to do some planning with that. It's the old planning word again. What we really don't want people to do is lose the opportunity to take advantage of just giving everything to each other in these circumstances. But actually, there is planning we can be able to do in wills to make sure we take full advantage of the reliefs and we take full advantage of anything that's left over from spousal exemption. So lots of planning. So yes, the short answer is yes, it's fine, and interspousal transfers is absolutely fine. But don't just think you're fine by giving everything to each other, because you will be missing a huge opportunity to do some planning around the new rules.
Yeah, fantastic. Time for one last quick question. We'll come full circle and end where we began and come to you, Emily, if we may. Moving away from IHT a moment. Can a UK resident that was deemed domicile still relocate overseas to avoid UK tax on overseas assets with the new non-dom rules?
Yeah, so it sounds like the new system is going to be based purely on residence, and it's going to be, even if they're not traditionally domiciled here, they're going to be subject to tax in the UK if they're considered a long-term resident, which at the minute the guidance is saying that you've been a UK resident for 10 of the last 20 years. So we don't yet know if you then move overseas, whether some of, if you've been in the UK for 10 of the last 20 years, whether some of that residence follows you or whether it's just a clean slate the minute you move abroad. We'll have to wait for clarification on that.
Fantastic, thank you. And thank you to all of you for your contributions today. It's been really, really great to have so many different viewpoints on these matters. And thank you to everyone for putting your questions in. I'm sorry we couldn't get through all of them. We are unfortunately time constrained, but thank you so much for all the questions. If you do have any further questions, please do contact your local Duncan Topless team and we'll be happy to help. Thanks to all our speakers today. Thanks to all our panelists. And thanks most of all to everyone for coming today. And I hope you found it useful. Thank you very much.